In this video, I am going to explain about what are the pros and cons of buying a property in a family trust or discretionary trust. So watch till the end. What is going on, guys? My name is Somen Mondal, and before we start, make sure that you like this video, subscribe the channel and turn the notification bell on so you get to see more videos like this. Alright, let's start. What are the pros and cons? Let's start with the pros. Before I start, I just wanted to say that if you have not watched my earlier videos regarding trust, how to buy a property in a trust, so go and watch it so you get to know what trust is. And in this video I am talking about the benefits and advantages and disadvantages. So let's start with advantages first, the pros. The first one is the asset protection. Most wealthy people, they want to protect their assets because it's one way to cloning yourself and protecting, so that if something happens, if there is any litigation happens, there your assets are protected. If you have a multiple trust and each trust, let's say you have 3 different trusts and each trust has 2 properties, and if something happens to one of the properties, then the other 4 properties of the other 2 trusts are completely protected. They can't touch anything on this. It's only within that trust, whatever properties there that might be endangered. So that's you basically creating a silo. So that's one of the way of protecting your assets. Another thing is that if something happens to you, in other words, like if somebody sues you for whatever reason, depends on what profession you are in, then your all other assets inside the trust are protected. Nobody can touch this unless the sue is basically you have not done any wrongdoings. It's purely legally you've been sued. So in that case, those assets are protected. So if you have set it up as a corporate trustee, then chances are that those assets are protected. If you are sued, or if one of the trust structure or some properties got sued, then pretty much you are also protected. If something you have on your own, that cannot be touched as well. So that's one of the thing. Asset protection is the number one reason people do, and it depends on what big structure you want to set it up. Remember how it's a great vehicle, especially in terms of asset protection. The second benefit that I am going to talk about is the profit distribution. As I said earlier, whenever you have an asset inside a trust and it makes money, the profit get distributed to the beneficiaries, and it is the trustee's discretion to who will get what. And because the profit can be distributed, let's say if you have a 20 years old son, daughter, or somebody who is not earning much, you can distribute as a trustee, can distribute that money and they don't have to pay much tax because they are on the lower marginal rate. Or if they don't have any income, so potentially up to 18,000, they don't have to pay any tax. So if let's say a trust which is earning $18,000 at the end of the year, and you distribute the whole amount to one of the beneficiary who does not have any income, pretty much you don't have to pay any tax, because that beneficiary up to 18,000, there is no tax in Australia. Okay, that's one of the benefits, profit distribution. It is the trustee's discretion who will get what. Trustee might decide that okay, 2 of the beneficiaries will not get anything this year, the 3rd beneficiary will get everything. That's why it is called a discretionary trust. So that's another benefit that I mentioned. And the last but not the least is the asset transfer. It means that as you know, in a trust is a corporate trustee, you don't own the trust or you don't own the property, you control the property. And the way you control is that you are the director for a company and the company is a trustee for a trust. So in reality, if you change the company's director and shareholders, so basically that company is basically owning. If you change it to someone else, that person is now going to control the trust, hence going to control from there onwards. So in other words, in order to transfer the property, you don't have to change anything other than the company director and shareholder, who is the corporate trustee. and by doing that you basically changing the whole structure. So one of the real life example would be, let's say you are controlling a trustee, you're the director of a trustee, and the trustee controls the trust, and the trust owns two properties. After 20 years, 30 years, your son has grown up now and you want to pass it on to your son, so you basically change the directorship or the shareholder of that company to your son, and then he actually now controls, and basically you don't have to pay any stamp duty for transferring it. It's just nice and simple. So that's one of the reasons why trust is very lucrative. Now let's go to the what are the disadvantages. One of the disadvantage is the setup cost and ongoing cost. As you know, the setup cost about $2,000 to $3,000 you have to pay to set up the trust. As I mentioned earlier, it depends on the accountant and what kind of advice that you take from a lawyer or accountant. That's how it is. You have to pay the ongoing cost as well, which is because it has a company as a trust, so it has a profit and loss statement and the tax return every year you have to do. So all the regulations you have to follow. That's generally about $1,000 to $1,500 per year cost at the time of recording this video. So that's the cost you have to bear. So that's one of the big disadvantage, because if you buy property in your own name, then those costs are not there. And the second one is the negative gearing, the negative cash flow. If the trust is making loss, then the loss cannot go out of the trust, or you cannot distribute the loss to the beneficiaries. The loss can stay or quarantine within the trust. So next year, the following year, when it will make money, then those loss will be offset first before it can distribute further. That's the reason. Whereas if it is in your own name, then the loss can be offset against your personal income, other income, and you don't have to pay tax on that. So that's one of the big disadvantage. Hence, in my opinion, you should always look for positive cash flow property in a trust. If it is a negative gearing or negative cash flow, then maybe trust is not a best vehicle for you, unless of course you want to protect it, so that outweigh this temporary loss. And the last but not the least is banks or the financial institution. They are very restrictive about trust. So if you buy in your own name, they will easily lend you money 80%, 90%, 95%. Whereas if you buy in a trust, then generally there are some additional documentation, guarantor signatures, and more importantly, they might not give you more than 80% or even sometimes 70% loan. So there are some additional money that you have to bring to purchase a property. So that's another disadvantage. So these are the pros and cons. You have to weigh up what you want to achieve, your big pictures, and then you decide whether you'll go with a trust or not. I hope you got something out of this video and you got some knowledge. Go and research a little bit more to get to know about other disadvantages and advantages. Thank you for watching.